Hi guys, good day to all of you. Lesson for today is lesson number 2, chapter 27, monetary policy. So in this lesson we're going to discuss about expansionary monetary policy and contractionary monetary policy. So let me give you a quick background about expansionary monetary policy and contractionary monetary policy. Monetary policy is used to increase aggregate demand. If a government wants to increase the economic growth rate and reduce unemployment rate, it may use expansionary monetary policy, reducing the rate of interest or by increasing the money supply. Monetary policy is often used to control changes in the price level in the economy. If it is thought that the price level is rising too quickly, the central bank may increase the rate of interest or reduce the growth in the money supply. The intention behind this is contractionary monetary policy, where the contractionary monetary policy would be reduce aggregate demand and the upward pressure on the prices. So, contractionary monetary policy means cut in the money supply or growth of the money supply, and by rising the rate of interest, which is designed to reduce aggregate demand. So, this is the background of the contractionary monetary policy and the expansionary monetary policy. So in this lesson, we're going to discuss on these two important types of the monetary policy. Let's get started. Instruction for students. Students are required to do the following, which are read, watch and do. Read Econs course book page 240 and 241 together with the attached notes given here. Watch video presentation lesson 2 uploaded in Google Classroom, this video presentation. Do 4-part question A and B only in your Econs course book page 242. By end of this lesson, students should be able to explain the interlink between money supply and the level of economic activity. You should be able to explain the expansionary monetary policy and the contractionary monetary policy and its effect on the government macro aims. So mainly if you see, expansionary monetary policy means increasing the aggregate demand. The intention behind increasing aggregate demand is to increase the national output and employment in the economy. This is to reduce the unemployment rate in the country. Right? So in other words, expansionary monetary policy will be implemented by the government in order to solve unemployment problem in the economy. Whereas if you look at the contractionary monetary policy, the intention is to curb inflation by increasing interest rate, decreasing the money supply, decreasing the consumption, investment and aggregate demand, as well as the level of employment, output and the general price level, mainly to bring down the general price level. So by bringing down the general price level, it reduces it overcomes or curbs the inflationary pressure in the economy. So let's start with the monetary policy and the macroeconomic aim. The first part is the achieving higher aggregate demand. So higher aggregate demand results in expansion of output, national output or national income, employment and growth. In order to attain higher aggregate demand, the central bank of the country or the government or the central bank, monetary policy mainly implemented by the central bank. So the central bank of the country will increase the money supply in the economy, directly increase the money supply in the economy, or also they will try to increase the money supply by reducing the rate of interest. So the amount of money supply in the economy will increase when the government reduce the rate of interest because the cost of borrowings become cheaper. Therefore, more loans can be easily taken from the banks, commercial banks. Therefore, consumers and producers, they will take more loans from the banks in order to do more consumption and also investment in the economy. So if you take a look at this diagram, M denotes money supply, R denotes rate of interest, C means consumption, I is investment, AD means aggregate demand, and Y is national output together with the, we can say, with the employment. So when the government increases the money supply at the same time by reducing the rate of interest, two important components will increase: level of consumption increase, level of investment will increase in the economy. As the AD, the formula for aggregate demand is AD is equals to C plus I plus G, X minus M, which is consumption plus investment plus government expenditure plus net exports. Alright, so since the consumption increases and investment increases, which these two components are directly related to the aggregate demand, therefore this will increase the or this will lead to higher AD, higher national output, higher employment. Right, as there are more demand for goods and services, therefore more jobs can be created. Therefore, this reduces the level of unemployment in the economy. So this is what we call as the expansionary monetary policy. Therefore, monetary measures aimed at boosting aggregate demand by lowering the rate of interest or higher money supply, which brings about expansion in output or income, employment, and also growth. It is called as the expansionary monetary policy. Hence, expansionary monetary policy is likely to help to achieve full employment and economic growth in the economy. Whereas if you take a look at the contractionary monetary policy, is the total reverse case scenario of the expansionary monetary policy. Well, if you take a look at this diagram below here, you can see that is the flow chart of contractionary monetary policy, where in order to implement contractionary monetary policy, the central bank will reduce the money supply and increase the rate of interest. As the central bank reduce the money supply and increase the rate of interest, these will affect the level of consumption and investment in the economy. The impact is it will reduce the level of consumption and level of investment in the economy. This is because as the rate of interest is higher, the cost of borrowing become more expensive or higher. Therefore, lesser consumers and producers will take loans from the commercial bank. Therefore, lesser consumption on the consumer durables and lesser business investments will take place. Hence, this will affect the aggregate demand. Therefore, the aggregate demand will be decreasing. Hence, this will reduce the output, national output, as well as the level of employment together with the general price level. So inflation can be curbed, okay, if there is a contractionary monetary policy has been implemented. If you take a look at this diagram here, so this diagram can be shown to explain how the general price level or how inflation can be curbed by increasing the rate of interest and also decreasing the money supply in the economy. In other words, by implementing the contractionary monetary policy. So if the government increases the rate of interest and decreases the money supply, so this reduces the aggregate demand. Therefore, the aggregate demand curve will shift to the left from AD0 to AD1. So at the initial equilibrium point is at point A, when the AD0 cuts the AS, aggregate supply, at point A. So the price level is at P0, All right, the price level is quite high. So when the government implemented the contractionary monetary policy, the AD0 shift to AD1 as the result of a decrease in the aggregate demand, consumption and investment. So new equilibrium point will establish at point B. Therefore, you can see the new equilibrium price at P1. The government successfully has reduced the price level, and they brought down the level of inflationary pressure in the economy. Hence, the use of contractionary monetary policy helped to attain the price stability. One of the macroeconomic aim is what? Achieving price stability. So in other words, by implementing the expansionary monetary policy, the government can achieve the macroeconomic aim of achieving full employment or maintaining low unemployment level in the economy. Whereas by implementing contractionary monetary policy, the government can achieve price stability in the economy. So that's all for today. Thank you very much.